The bad news is that the Fed has become extremely aggressive and hawkish. The good news is that we are beginning to get data that is confirming that the economy, the U.S. economy, is in recession. And if you've tuned in before, you know that we believe that Europe and China effectively have been in recession as well. So now a global recession. We're also getting a lot of indicators that prices are coming down. And I think this notion that the inflation that everyone has been worried about is quite a wrong way of looking at the world right now. We believe that deflation is the much bigger risk. We've been saying this for a time. We've been ridiculed for saying it. And we were challenged by those who were sure that we were back into a 70s style inflation scenario. We think that the pricing action, and I'm not just talking about stocks and bonds, I'm talking about commodity prices, crypto prices, and perhaps soon even housing prices, that many people will conclude the greater risk is deflation. And as you know, we don't think deflation is a bad thing per se. It is a bad thing the way the Fed has approached it, we believe. But deflation can be a very good thing if it is caused by technology and progress. And we think we're going to see a lot of that over the years. But right now, we're looking at bad deflation. And we're going to have to get through this. So bad news, good news. Darkest before the dawn. We think growth is going to be scarce this year. And as you know, innovation is all about growth. Innovation is also about solving problems. We have a lot of problems now. A recession is going to be providing another set of problems. Crypto had its worst quarter since 2011. And it's a much more mature market than it was back then with the boom bust. So that's saying something. The S&P down 20% year to date, NASDAQ down roughly 30%. So the stock market has not seen a worse year to date since 1962. And that was when the Cuban Missile Crisis took place. And then what happened after that is we ended up in the Great Society, guns and butter, and inflation took off. But first, the stock market was a barn burner. It was very hot from 62 to 66. When it comes to bonds, this has been the worst year-to-date performance in bonds in anyone's lifetime. And by some measures, you have to piecemeal the bonds, but to try and get the record, the worst since 1788. That's more than 250 years ago, or almost 250 years ago. So it's been a very, very rough market for investors. We think there is light at the end of the tunnel. The light is that the Fed is getting a lot of signals that will ultimately end up in the lagging indicators called the PPI and the CPI. They're getting a lot of indicators, and I think a lot of companies are going to be telegraphing in their earnings reports this next month that we are in recession. And I do believe the Fed will do a double take. Big down rounds happening very quickly. He repeated what he said in Jackson Hole, essentially. They're focused only on prices. Now, they have a dual mandate, employment and prices. Frankly, I'm happier that they're focused on more of a price rule, so that's good. But I think the reason for the pivot is going to be a massive amount of deflation in the system. It's already here. If you look at commodity prices, the gold price, for example, it actually peaked in August of 2020, and it's at the lower end of a 2-year range. While copper has broken down, oil is breaking down, lumber has crashed, iron ore as well. Freight rates out there are suggesting that the supply chains are loosening up quite significantly. The rates are coming down. So we've got deflation in the system. And the way I describe what's going on right now, I was in my early days in my career in the early 80s when Volcker was taking a sledgehammer to inflation because it was embedded in the system after 15 years of profligate spending, Vietnam War, Great Society, and then going off the gold exchange standard. A sledgehammer, that's what he needed. That is what I believe Chairman Powell thinks he needs. And we just don't think that's true because we see so much deflation. And then one more thing. We also see a massive inventory overhang around the world. You've got Europe in recession, China in recession effectively. And here in the United States, retailers are bulging with inventories, which will have to be cleared with discounts. So we think we're going to see some major downside surprises in inflation during the next 3 to 6 months. The Fed is looking at the PCE deflator, which peaked in February at 5.3%. It's down to 4.6%. And we believe we've already seen some negative numbers. Nobody believes them. We do. And we believe we're going to see some more negative numbers during the next 3 to 6 months. So wouldn't be surprised to see it well down into the threes in the next 3 to 6 months, if not into that 2 handle. And I think if we get enough sequential declines, that the Fed will change its tune quite dramatically. I think that the Fed will be looking at the sequential numbers, many of which will be negative, and that will encourage them. Even if we don't have that 2 handle, we're in the threes and we're coming down quickly, I think they'll change their tune. And we think profits are going to be under tremendous pressure until some of these cost declines make it through and inventories are cleared. Now, we do not think this will be anything like 08, 09, which I know many people fear. We think it's much more of an inventory recession and a drag from the rest of the world, Europe being crushed by energy prices, China readjusting to quote unquote common prosperity. So I think it'll be more of an inventory recession. And, there's been a lot of denial that we are in recession. We think we are, and that we'll be coming out next year, whereas many people, forecasters are saying we'll be going in next year. So I actually think the market will be looking up as we're exiting this year. We do think there's been some labor hoarding in here. The employment numbers have looked strong. If you peel the onion a bit, the underbelly of employment is not strong, with household employment essentially flat over the last 4 to 5 months, which includes a lot of small businesses. That's where we see a lot of the pain right now. But the labor hoarding is because companies couldn't get labor during the supply shock and the COVID. And so now that they can, they're holding on a little longer than I think they would normally. I'd be surprised if we go all the way to 6%. I do think the inventory recession will be somewhat sharp and will take the unemployment rate up, but I'd be surprised to see us get all the way to 6%. Our strategy has been hurt very, very much, as have most growth strategies, by the fears associated with inflation and higher interest rates. And as I mentioned, we think that's going to turn around. We see the growth coming out of these 5 platforms. These are 5 innovation platforms. These are exponential growth trajectories. And we faced a lot of COVID-related comparison issues in stocks like Roku, Teladoc, Zoom, and so forth. So there's been a lot of confusion on very short-term indicators in the market, but the explosive growth is there. It has happened, and we think it's going to continue. We see that in the global public equity markets, truly disruptive innovation, which is all we focus on, is priced at roughly $8 trillion in value in the markets today. That number, we believe, is going to more than 200 trillion during the next 8 to 10 years. So it's going from less than 10% of the global public equity market to what we believe will be 60%. And the reason we believe that it will move to that level is because these platforms are going to disrupt the traditional world order in a way like we have never seen before. We were not around in the early 1900s when telephone, electricity, and the automobile disrupted the existing world order. These are 5 platforms, not 3, and they involve 14 different technologies. So what we think, if we're right about what's going on in the economy right now, and inflation is going to come down fairly dramatically, that will be a big positive for growth stocks. The compression in our performance, what we do during periods like this is we concentrate our holdings towards our highest conviction names. So we have taken our flagship strategy from 55 names down to 33 names. We did the same thing during COVID, but that was just a 1 month worth of pain, and it was awfully painful over a month. And from the lows in COVID, we moved up in the span of less than a year by 360%. So that was probably, ahead of its time. We've corrected tremendously. And now we have many what I would consider deep value stocks if you give us a 5-year investment time horizon. But I will say now that the 2-year Treasury and the market itself has priced in
at least 4 interest rate hikes. This possibility is priced in the equity markets too, increasingly. And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economy. So I think the fears here are going to shift from rising interest rates and higher inflation potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem.
Thanks for watching. And if you liked this video, please let me know about it in the comments section below. And be safe and wealth.